What's up, Effortless investors, and welcome back to the channel. Every investor has scars. Some are small scratches, others are full-on financial belly flops. In today's video, I'm going to share my 5 worst investing mistakes, so hopefully you don't have to make them too. This isn't a horror story compilation by any means. It's more like a comedy of errors. Now, I'm not a financial advisor, just a simple 9 to 5 guy with a realistic investing portfolio that I contribute to effortlessly. All the content in this video is purely for informational purposes. If you like this type of content, make sure you like the video and subscribe for more content and future portfolio updates. With that out the way, grab yourself a cup of tea and let's dive into the mistakes that made me the effortless investor that I am today. Let's start with a simple one. I didn't set an investing goal. Investing without a goal was like driving a car without knowing the destination. You hop in your car on a Sunday afternoon as you feel guilty because you've not done anything all weekend up to that point. You don't have anywhere to go, but you feel like you'll figure it out. Now, I'm not saying that you won't. You may end up at a beautiful viewpoint, but there's just as much of a chance of you driving around aimlessly wasting hours and fuel. Without an investing goal, there's a high chance that you will feel like you're moving forward, but in reality, you're just moving in circles, or as I did, moving backwards. I had previously started investing back in 2016 for about a year and never really knew what I was doing. I had no goal other than to make money and ended up losing about £200 from my £300 savings that I was using. Those savings now make up a portion of my emergency fund. When I began investing again in June 2024, I felt like I was in a better position to succeed, but still didn't really have an end goal. It took a harsh lesson of losing 12.5% in the first 7 days to wake me up and take it more seriously. Now I know my goals, of which there are 2. My primary goal is to hopefully build a little extra cushion for my retirement. I'm realistic, so I'm not going to say I'm trying to be a millionaire, but I'm not going to turn it down if it happens. The secondary goal is to improve my financial literacy, so in turn I can teach that to my children, thus hopefully starting to improve the generational financial literacy and giving my children a better foundation from which to start their adult lives. With goals in place, everything I do from an investment standpoint fits around them. So before you make a single investment in the stock market, make sure you have your end goal in place. It's no different to saving for a holiday or Christmas with a standard savings account. Moving on to the next mistake. It's closely related, often confused, but equally important. I didn't have a plan. I thought, just buy some well-performing stocks, maybe an ETF or 2 for diversification, and that should work. Which on the face of it isn't wrong. Perhaps I just didn't execute it correctly. In retrospect, what I did instead of doing my research and picking the few stocks and ETFs, I kept watching video after video after video of other people's investments and thinking, that looks good, I'll try that. The problem with this is that it led me to investing in far too many stocks and far too many ETFs, rather than just a select few that I was confident in. Everything was new and everything was shiny. Without my own plan, I ended up reacting emotionally instead of logically, and fell back into my old routine from 2016 and started treating it like day trading. Selling and buying stocks daily every other day, it just didn't work. It was like building a flat pack wardrobe without instructions. Sure, you might end up with something that holds clothes. Or you might have 3 leftover planks and a wobble you can't quite fix that ultimately collapses on you. My plan now is simple. 70% of my allocation goes to 2 ETFs that are focused on growth with some dividends to give me that dopamine hit every few months. 25% is invested on dividend paying stocks with a 50% focus on UK dividend aristocrats. The remaining 5% is then split into some more speculative investments with a 3 to 5 year evaluation period. Ultimately though, what plan you use is up to you, but it is important that it is your plan and fits your end goal. Do not get swayed by the other investors out there, including myself. By all means take another plan, but make sure you research each investment and make sure it aligns with your goals and risk tolerances. Now, I briefly touched upon this next mistake a few minutes ago. This one still makes me facepalm simply because I've done it on 2 separate occasions. I panicked at the first sign of a loss. The moment an asset dipped, even slightly into the red, I was sweating like I'd just seen my children walking towards a cliff. So I sold, only to watch the stock recover days, sometimes hours later. Panic selling is the financial equivalent of running out of a cinema because the music got scary, just before the hero saves the day. Stock prices ebb and flow. It's unrealistic to expect an asset to keep going up in price. It's eventually going to go down. This seems obvious, and it was, but in practice, for whatever reason, I still panicked. Thankfully, on this occasion, I didn't continue to panic. I took the month of July to refocus, actually come up with a goal, and subsequently a plan to achieve that goal. For me, this seemed to alleviate that panic, for the most part at least. At the end of the day though, I'm still human. So if any of my assets, or my portfolio overall drops, it does cause a raised eyebrow or two. But there's no panic anymore. I could also attribute the lack of panic to experience. The longer you invest for, the more stocks dropping in price becomes normal. And the more normal something becomes, the less panicked by it we are. So the lesson learned here, red numbers don't always mean danger. Sometimes they're just an opportunity to practice patience. Moving on to mistake number 4. It's another important one and something that gets stressed by all investors. Research. I didn't do enough research. This goes hand in hand with mistake number 2, not having a plan. It's very easy at first to go with companies you recognize, and I'm not saying you shouldn't. But whatever stocks you invest in should be ones that you have thoroughly researched to fit your investment plan. I'm extremely guilty of not researching enough in the beginning. Back in June 2024, when I started, you can see here on the 20th and 24th of June just how many transactions I made. I even invested in Trump Media. I've kind of forgotten about that one. You could ask me now why I made those trades, and I still couldn't tell you. I think from memory I was just going off of what stocks were appearing on the Trading 212 homepage in the app. Couple that strategy with also taking advice without research from the community section on Trading 212, and it ended up being a mess that first 6 weeks, ultimately leading to me losing 15% in total. My plan is important, as it helps me assess what variables I need to measure the stocks or assets by. I usually start with asking myself this question. What do I need to confirm or disprove about an asset before I invest in it? From then, I'll analyze current and historical performance, earnings, business dealings, sector performance, PE ratios, and various other variables before I even invest in a stock or asset. The research is important because ultimately it's where you're putting your money. So make sure you do your own due diligence, however in depth that may be. And finally, we arrive at mistake number 5. If it isn't obvious already, I did way too much, too soon. This one always makes me laugh simply because it involves the buzzword diversification. When I started, I understood the basic premise of the word, but within the context of investing, I don't think I did. And you can see that in the investments I made early on. My approach to diversification seemed to be just buy a lot of different stocks, which obviously didn't yield a positive result. So what is diversification within the context of investing? The core of it is don't put all your eggs in one basket, which I appreciate isn't too far from my initial understanding of just buy a lot of different stocks. But in practice, it's far more nuanced than that. And that's what I didn't understand and appreciate at first. Diversification includes not just the volume of stocks you are investing in, but how you spread your investment across different asset classes, whether it's stocks, bonds, cash, properties, or commodities. You've got different industries, regions, and company sizes to consider. How you diversify your portfolio is up to you. In my view, again, that should be dictated to you by your goal and your plan. Looking back at where I went wrong, in my head at the time, I had about 20 to 30 stocks, which I felt like were diverse. In reality, though, everything was tied together. If one sector went down, half my portfolio sneezed with it. Now, I'm trying to keep things clean and simple with as little overlap as possible. So, those are my 5 worst investing mistakes. No goals, no plan, panic selling, poor research, and going wild with diversification. Each one set me back, but each one also taught me something crucial. Investing isn't about being perfect, it's about learning, adjusting, and more importantly, sticking with it. If you've made one or two of these mistakes yourself, don't beat yourself up. You're not alone. Just remember, every scar is just an experience in disguise. If you enjoyed this video, give it a thumbs up and maybe share your own biggest investing mistake in the comments. And of course, subscribe for more investing tips, portfolio updates, and the occasional whimsical humor. Until next time, keep it simple, keep it realistic, and as always, keep it effortless.